The Federal Reserve interest rate forecast is a prediction of the future path of the U.S. Federal Reserve's targeted interest rate. The rate that the Federal Reserve forecasts can have a significant impact on the cost and availability of mortgage funds and indirectly influences the cost for mortgages. The relationship between the two is nuanced and intricate, so we'll take a look at some of those details. The Federal Reserve rate forecast gives us an idea of where the Fed wants to go with interest rates. The targeted rate affects the cost of borrowing money, the availability of credit, and other economic indicators like the unemployment rate and inflation and productivity levels. For businesses and investors alike, closely monitoring the Federal Reserve's interest rate decisions can help guide their own financial decisions. By understanding the economic factors that affect the Federal Reserve's interest rate decisions and anticipated timelines for future decisions, you can stay ahead of the game. The Federal Reserve interest rate, which banks use to lend and borrow money to one another in the interbank market, is one of the most important economic tools and can affect the mortgage bond market. Many lenders are quick to point out that this is an indirect relationship. Still, the interest rate is a very powerful lever that the Federal Reserve uses to influence economic activity, and change in this rate can have a significant impact on the mortgage bond market. When the Federal Reserve sets a low interest rate, the cost of borrowing and lending is lower, and this can lead to increased demand for mortgage bonds. This extra demand will cause the prices of mortgage bonds to go up, and this increase in prices provides an incentive for lenders to expand their loan offerings, which will help to increase the availability of mortgage funds and drive down the mortgage rate, the interest rate. On the other hand, when the Federal Reserve raises interest rates, the cost of borrowing and lending is going to rise, and this can reduce the demand for mortgage bonds. As the demand for bonds goes down, prices are also going to decrease. This will reduce the incentive for lenders to extend mortgage loans and lead to higher mortgage rates. The Federal Reserve's interest rate decision is based on its outlook for the economy. And if they think they need to lower the interest rate, indirectly they end up lowering the interest rate for mortgages. On the other hand, when the Federal Reserve raises interest rates, the cost of borrowing and lending is going to rise. And this can reduce the demand for mortgage bonds. As the demand for mortgage bonds goes down, prices are also going to decrease. This will reduce the incentive for lenders to extend mortgage loans and lead to higher mortgage rates. The Federal Reserve's interest rate decision is going to be based on the outlook for the economy. By closely observing the economic data, the Federal Reserve tries to anticipate how the economy is going to perform in the near and/or medium-term future. The Federal Reserve publishes a forecast of its monetary policy intentions which shapes the expectations of borrowers and lenders alike. Knowing what the Federal Reserve is likely to do is going to help investors predict the direction of the mortgage bond prices and the mortgage interest rate environment. The Federal Reserve interest rate decision has an impact on the mortgage bond market, but there are other factors at play. For example, investors may be more or less willing to invest in mortgage bonds due to their perceptions of market risk. Additionally, the performance of the economy as a whole can also affect the mortgage bond market. A strong economy is likely to lead to increased demand for mortgage bonds and lower mortgage interest rates. More demand, lower rates. Conversely, a weak economy can lead to higher mortgage interest rates due to decreased demand for mortgage bonds. Overall, there is a strong relationship between the Federal Reserve's interest rate forecast and the mortgage bond market. The direction of the Federal Reserve's interest rate decision has a significant impact on the availability and cost of mortgage funds and plays a large role in shaping the expectations of borrowers and lenders. Understanding the Federal Reserve's interest rate decision is crucial for predicting the direction of the mortgage bond market and the direction of the mortgage interest rate. The Federal Reserve's interest rate forecast, the outlook for interest rates in the months and years ahead, is of major importance to the United States economy. As the central bank of the United States, the Federal Reserve is tasked with setting the benchmark short-term rate of interest, which then affects all other rates in the market. If the Federal Reserve raises interest rates, other rates in the market typically rise as well. Thus, changes in the Federal Reserve's interest rate forecasts are of considerable relevance to businesses, investors, and consumers. The Federal Reserve has traditionally used its announced interest rate targets as a tool to stimulate or slow economic growth. For example, when the economy is slowing, the Federal Reserve might lower its target rate in order to encourage more borrowing, investment, and spending, which should help boost economic growth. Conversely, if the economy is too hot or strong, the Federal Reserve might raise its target rate in order to prevent the economy from heating up and avoiding the potential for runaway inflation, which I'm sure you've heard a little bit about recently. Forecasting the Federal Reserve's interest rate for the future is a complex task due to the many factors that can influence it. For example, changes in the economic data such as GDP and unemployment can change the Federal Reserve's outlook. Long-term trends like inflation and financial market conditions are also taken into consideration when gauging the future of interest rates. Invariably, each forecast is based on assumptions of what the future data is going to be, which can be difficult to predict since economic data can change very unexpectedly in either direction. The Federal Reserve releases its interest rate policy statements 8 times a year, and it updates projections at each of the meetings. The Federal Reserve usually updates its short-term interest rate forecast in the statement on longer-run goals and monetary policy strategy. Very official. Here, the Federal Reserve states its long-term objectives and the various factors it's going to consider when measuring the stance of policy. In addition to its official interest rate statements, the Federal Reserve also uses economic projections to help inform its decisions. These projections are found in the Summary of Economic Projections and Report on Economic Outlook, which are released quarterly. This report incorporates 3 different plausible scenarios for the outlook and provides an outlook for economic indicators such as inflation, unemployment, and GDP growth. Finally, the Federal Reserve can also adjust its own interest rate forecast over time as new data becomes available. For example, the Federal Reserve may modify its outlook if economic data points to a different direction than the one it expected. Similarly, if the Federal Reserve's own policy decisions result in unexpected outcomes, they may update their interest rate forecast to account for those decisions. The Federal Reserve's target and expectations can have an effect on mortgage rates. When the Federal Reserve is forecasting higher rates in the future, lenders may raise their mortgage interest rates in anticipation of this increase. This can add up to considerable expenses if rates are raised before the transaction closes, or if borrowers take out a long-term fixed-rate mortgage that has to be paid off later when the higher rate isn't in effect. Alternatively, bearing in mind that the Federal Reserve's predictions may not always come true, homebuyers may be able to obtain a lower rate mortgage if the Federal Reserve forecasts lower rates. In addition to anticipating changes in rates, monitoring the Federal Reserve's rate forecast can also be helpful for homebuyers by providing more insight on which way the market might be heading. In addition to interest rates, this information can be useful for deciding how much to save for a down payment or for evaluating the impact of different loan structures on monthly payments. Understanding the Federal Reserve interest rate forecast can also provide extra insight on overall economic trends, including the outlook for employment, wages, inflation, and consumer spending. In summary, the Federal Reserve's interest rate forecast provides important insight into the future of interest rates and the health of the economy. By considering both current economic data and its own projections, the Federal Reserve is able to craft an outlook for how it will adjust to its target rate in the months and years ahead. This can help businesses, investors, and consumers make educated decisions about their investments. If you're looking to buy a home in Salt Lake City, check out my video about the best neighborhoods around. If quality of life is the most important thing to you, you need walkability, entertainment, and food nearby. This video is just for you. I'm Ryan Shupit with Active Utah Homes. I'm Ryan Shupit with Active Utah Homes at Realty One Group Signature. On this channel, I teach you everything you need to know about buying your first home.